You've probably heard people say things like, just invest in the S&P 500, or ETFs are better than mutual funds. But no one really explains what that means in real terms. In this video, I'll explain all four using one simple analogy, and I'll also show real examples like Apple, Google, and Amazon, so everything actually clicks. Whether someone invests in Apple, Tesla, or the entire stock market, the goal is the same: grow money over time. Think of investing as a journey to financial freedom. The difference isn't where people want to go, it's how they travel there and how much risk, cost, and effort they're willing to accept. Here's something most people don't realize. Whether you invest through an index fund, ETF, or mutual fund, you often own the same companies, like Apple, Microsoft, Nvidia, or Amazon. What changes isn't the destination, but the vehicle. How your money is managed, how much it costs, and how flexible it is. Index funds are like public trains. They follow a fixed route and include every major stop. For example, an S&P 500 index fund automatically invests in the 500 biggest US companies, Apple, Microsoft, Amazon, Google, without trying to pick winners. It just moves with the market. There's no fund manager waking up and deciding whether Apple is good or bad today. If Apple is 7% of the S&P 500, your index fund holds Apple at 7%. When companies grow or shrink, the fund adjusts automatically. That's why index funds are simple, low cost, and very hard to mess up. Over long periods, index funds have beaten many professional fund managers. Not because they're smarter, but because they avoid mistakes and keep costs low. When the market grows at around 7 to 10% historically, index funds capture almost all of that growth, while many active strategies leak returns through fees and bad decisions. Mutual funds are like taxis. You're still going toward financial growth, but now there's a driver, a professional fund manager, deciding where to go. For example, a mutual fund like Fidelity Blue Chip Growth Fund actively chooses stocks such as Apple, Microsoft, and Nvidia based on what the manager believes will perform best. Unlike index funds, mutual fund managers actively buy and sell stocks. If they think Tesla is overvalued, they might reduce it. If they believe Nvidia has potential, they'll add more. This can outperform the market. But it also introduces human judgment, emotion, and timing risk. Because mutual funds pay research teams and managers, their fees are higher. An index fund may charge 0.05%, while an active mutual fund might charge 0.8% or more. That difference may sound small, but over 20 or 30 years, fees quietly eat tens of thousands from your returns. Some mutual funds do beat the market, especially for short periods. But studies show that most active managers fail to consistently outperform index funds after fees. That's why many professionals use mutual funds selectively, not blindly, and often combine them with index strategies. ETFs, or exchange-traded funds, are like Uber. They combine the simplicity of index funds with flexibility. For example, SPY or VOO track the S&P 500 just like an index fund. But you can buy or sell them instantly during market hours, just like a stock. ETFs are popular because they're cheap, transparent, and flexible. You can own hundreds of companies like Apple, Amazon, and Google through one ETF while still having control over when you buy or sell. That's why ETFs are now widely used by beginners and professionals. Hedge funds are like private jets. They're fast, exclusive, and not meant for everyone. These funds are usually available only to wealthy or institutional investors and use complex strategies like leverage, short selling, and derivatives to generate high returns. Unlike index funds or ETFs, hedge funds don't just buy stocks and wait. They can profit when markets fall by short selling or amplify gains using borrowed money. For example, funds like Bridgewater Associates or Renaissance Technologies use mathematical models and global macro strategies. Hedge funds often charge a 2 and 20 fee, 2% yearly management fee plus 20% of profits, That means even if returns are average, investors still pay heavily. Some hedge funds outperform, but many underperform after fees and volatility. Hedge funds are designed for people who already have diversified wealth and can afford losses. They're not a replacement for index funds or ETFs. For most individuals, hedge funds add complexity without adding consistent long-term value. Index funds are buses, simple and reliable. Mutual funds are taxis, guided but costly. ETFs are ride shares, flexible and efficient. Hedge funds are private jets, powerful but risky. Smart investing is about choosing the right vehicle for your journey, not the fanciest one. For most people, a mix of index funds and ETFs is more than enough. Funds like VOO, VTI, or total market ETFs already give exposure to thousands of companies worldwide. You don't need complexity to build wealth. You need consistency and time. Professional investors rarely rely on just one type of fund. Instead, they combine different vehicles to balance growth, cost, and risk. For example, a pension fund may use index funds for stability, ETFs for flexibility, and a small hedge fund allocation for diversification. A realistic long-term portfolio for most people might look like this: 60% in index funds like VTI or S&P 500, 25% in ETFs for sectors like tech or healthcare, and 15% in actively managed mutual funds. No hedge funds needed for most individuals. Index funds form the backbone because they're low-cost, diversified, and proven over decades. Funds tracking the S&P 500 have historically returned around 8 to 10% annually over long periods. That consistency is why institutions trust them for retirement money. ETFs allow investors to tilt their portfolio toward opportunities. For example, QQQ focuses on tech giants like Apple and Microsoft, while Vanguard Total World ETF gives global exposure. ETFs let you adjust direction without rebuilding the entire portfolio. Mutual funds can be useful in areas where markets are inefficient, such as emerging markets or small-cap stocks. Skilled managers may outperform there. However, higher fees mean they should complement, not replace, low-cost index and ETF holdings. Hedge funds can add diversification, but for most people, they increase complexity without improving results. High fees, lockup periods, and unpredictable performance make them unnecessary for personal wealth building when simpler tools already work well. Ask 3 questions. How long am I investing? How much risk can I handle? How involved do I want to be? Long-term, low-effort investors usually choose index funds. Active investors may add ETFs or select mutual funds carefully. Index funds are highways, slow, steady, reliable. ETFs are steering wheels, flexible and responsive. Mutual funds are guided tours, helpful but costly. Hedge funds are private jets, fast, extremely powerful, highly customized, and very expensive. You don't need insider secrets to build wealth. You need clarity, patience, and the right tools. Start simple, stay consistent, and let time do the heavy lifting. Smart investing isn't about doing more. It's about doing the right things well. If you want simple, clear explanations about money, investing, and building long-term wealth, subscribe to Money Mind. No hype, just clarity.